Oil prices are stabilizing near 2 months highs. The news from China reassures oil traders. Recent data showed that China's crude oil imports hit the highest levels in nearly 3 years in March. However, OPEC Plus oil producers remain concerned about a possible decline in demand for hydrocarbons in the face of renewed signs of a global recession. Additionally, oil prices are pricing in a reduction in oil production in Russia and a halt to exports from Iraq's Kurdistan region. Against this background, market anticipates supply shortages, which in turn fuels a rally in oil prices. However, the US-based International Energy Agency anchors OPEC Plus and predicts that supply will exceed demand both in 2023 and 2024. According to the trading chart, a short-term rise ended with a pullback after the quote approached the level of $87.50 per barrel. From a technical point of view, the asset has hit the resistance zone. Against this background, it can be assumed that the 3-week ascending cycle has come to an end and is now likely to turn into the stage of a phased decline. If the quote consolidates above 90, a primarily signal of a change in the medium-term trend will come. In this case, oil prices will gain stronger upside momentum. Meanwhile, gold is still trading at around the high of $2,040 per troy ounce. Despite technical overbought signals, speculators continue to go long, while trading volume keeps growing. If this trend continues, the yellow metal may soon hit a new all-time high. Yesterday's macroeconomic reports from the United States heightened expectations that the US Central Bank would finally tone down its aggressive approach to interest rate hikes. Data from the Labor Department showed that producer prices unexpectedly fell in March, by the most in nearly 3 years. The day before, inflation data indicated a significant slowdown in consumer prices, and thus markets now expect the Fed to start cutting interest rates as early as July. And notably, such changes in the monetary policy are favorable to gold as an investment asset. Now let's move on to the dollar-ruble pair. Despite a slight pullback, the ruble has stabilized in the range of 81 to 82 rubles per dollar. Nevertheless, an uptrend seems to remain intact. If the price returns above 82.60, the pair will gain fresh upside momentum and hit a new local high. However, fundamental statistics suggest a possible slide to the level of 81 rubles per dollar. Oil prices and a broadly weaker dollar are unlikely to allow the pair to extend gains. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.